Good evening, everybody. Once again, welcome to today's session. Quick one, let me follow up with Prof. Thank you for the presentation. There seems to be quite a few definitions that we've gone through in your presentation. And what I'd like to hear from you, Prof, is I think there's three definitions. Green investment or green, and then you have sustainable investment, then you have responsible investment.
Yes.
So maybe you can give us a rundown as to how do you reconcile these three? And then we hear from Robson and also from Pei Hua in terms of their views of how do we define this? Because in the brick and mortar world, we just know one thing, profits.
Yes.
So up to you, over to you, Prof.
Sure. Yeah. Maybe just to set the context, why do we have so many definitions and everything? I think partly this is just my personal view. Partly because when we look at sustainability and kind of like I talk about the timeline of how various sustainability initiatives from the NGOs, right? So NGOs, as they are non-government organization, and you have all this evolution or development of different NGOs, and they come up with their own concepts, ideas. So let's say, for example, and this is just an illustration, maybe GRI is the organization that come up with the word sustainable investing, and they have a definition for that. And then maybe TCFD come up with green investing, and they have a definition, pretty much similar, but yeah, they use a different phrase so because it's bottom up, so I think what happened is that these NGOs sometimes they talk or they coordinate, but it's not like perfect coordination, and different leaders of these NGOs have different views, ideas, and so on and so forth. So I think that's why we have so many like various definitions. What I show for this presentation is I think just a tip of the iceberg. For example, in accounting or sustainable reporting, we have things like triple bottom line, and then I mean it's just another kind of definition that came out in this entire evolution over the last 30, 40 years. So that's my take
Do
on
we
it.
see a harmonization, Prof? Where do I put my money? I mean, it's kind of confusing. I mean, even if I lose my money, I don't know what I've lost it on.
So I'm an accountant, so I may have a bias.
Yeah.
Some harmonization might come from the ISSB. So ISSB, basically the International Sustainability Board is under the umbrella of IASB, right? International Accounting Standard Board. And I think basically they are starting to develop standards. So we have IFRS S1, S2, and I think more standard to come. And the advantage of ISSB is that because you have so many countries adopting IASB accounting standards, so I think that might be one way whereby you have some of this harmonization. Even for, let's say, for TCFD, for SASB, all these organizations are now subsumed within the IASB umbrella. So going forward, definitely I think there'll be more convergence. And I think the two biggest players in my view would be GRI, because GRI has kind of like a first mover advantage, and ISSB because of the backing of ISSB. Yeah, so that's my take on that.
Thanks, Prof. So I think harmonization will come, and the thing to look out for is ISSB because the bean counters are going to tell us how to count the uncountable.
Yeah.
So maybe over to you, Robson. Thanks, Prof. Robson, what's your view on all these definitions on how do we count the uncountable? Because when you count profits, it's dollars and cents, but now you ask me to count in sea level, in climate change, in community happiness. How do I count happiness as a profit?
Well, I think at the end of the day, however you define or whatever terminology you apply, I think it points towards the goal of ESG. In other words, whether you call it sustainable investing or responsible investing, it has to be measured against what do you think a company's values, their ethos, are they consistent with moving towards a more environmentally responsible way of business operation? Do they take into consideration the social aspects of a corporation's activities? The people, do you have diversity? Do you take care of the mental wellness of your employees? And last but not least, governance. Are you, do you engage in nefarious activities, money laundering, corruption, and what have you? So there's no one size fit all. It's like in accounting. I'm not an accountant, but you have US GAAP, you have International Financial Accounting Standards, Singapore International Accounting Standards. But at the end of the day, what you want to measure against is, like in accounting, does the set of numbers, or do the set of numbers reflect a true and fair view of the state of financial affairs of the company? So that's my take, because I think everything is still evolving. From my experience in advising listed corporations in particular on their sustainable reporting, there are precedents, but people tend to gravitate towards a kind of precedent base. It's a kind of what's the market standard of writing, and therefore there is also a risk of greenwashing, which I invariably remind directors that, look, you are responsible for what you say that is publicly disseminated and published, because at the end of the day, if you don't measure up, or what you are doing is just greenwashing or what have you, then you might run foul of the disclosure rules, might run foul of your responsibility as directors of a listed company. So that is something that perhaps members of today's conference or panel discussion should also consider this, in deciding on what, amid all the varying definitions, what are the key fundamental principles we want to enshrine.
Thanks.
That's my take.
Thank you, Robson. Give me a second, and I'll come to you, Pei Hua, in terms of your views on the definitions. So, Robson, thank you. You brought up quite a few important points: greenwashing, measurement, ESG factors. So, if you look at the stock exchange listing rules in Singapore Exchange, they've issued a requirement that listed companies must disclose ESG factors, and there's 26 of them, if I'm not wrong. And some of these factors relate to things like staff training and training hours, for example. So if the company has more training hours, does it necessarily mean that there's more profits? So I'm keeping this open, so you don't have to answer this, but it's something that we have to go through, and it's related to greenwashing. So if I disclose these 26 ESG factors, what is good and what is bad? And I'll come to that in a while. But in the meantime, let me go to Pei Hua. So Pei Hua,
Sure.
how do you deal with all these definitions of ESG investing, responsible investing, green investing, sustainable investing? Where's the money? I mean, Tom Cruise will say, show me the money.
Right. I mean, speaking from the investment professional's perspective, I think if you talk about ESG funds, they typically would have very clearly defined investment mandate. Whereas for those non-ESG funds, it's really evolving, as what Russell had mentioned, as to how the investment professional incorporate ESG element in their investment decision process. It really varies from firm to firm, funds to funds. But I think it probably suffice to say, investor would appreciate and look at the angle that the company incorporates some form of decarbonization strategy, or putting measures in place to help we achieve the global net zero target. And I think we also look at companies who may not be that ESG compliant, have a low rating, but if they show improving ESG rating over the years, I think that is also a good thing to have as well.
So you're saying that, thanks for that, Pei Hua. So you're saying that if the company talks about decarbonization, talks about net zero, that's something worth investing in. So to you, that's the definition of ESG investing. I will invest in the company that talks about decarbonization.
No, I mean that is not what I meant. I was just saying that what the investment community are looking at. So besides of course, the fundamental remain the key. So we invest in a company with a strong fundamental. From that, you have to add in now we also have to add in the ESG element in our investment process. So it must have some form of, I would say the company should have done some, to have a strategy on how they would decarbonize, how they look at improving the ESG. So this has been taken into account, into consideration in the investment decision process.
So fundamentals are
It's
still
on top.
important.
Yes.
So bean counting is still important on top of the things which are uncountable, like decarbonization, staff training, good things to do for the community. So it's a two-layer kind of thing.
You have to converge and have like you said, harmonize. So it would be irresponsible for us to say, invest in this company because they are very good in ESG. But at the end of the day, you have to be responsible because the investment is meant to have return. If not, then it will be called charity, I suppose.
That's another matter altogether. But thank you for that, Pei Hua. That's a very good analogy that we need two layers. It's like a 车成功, the 7-layer cake. We need multiple layers. The basic fundamental layer must still be there. So let's go to Prof. Kevin, and then we'll come back to Robson and come back to Pei Hua. So, Prof, let me ask you. So we now got some more or less a definition of responsible investing, green investing. Must have a layer at the bottom and the top, second layer in terms of doing good.
Yeah.
So you do good, but what does good look like? So if I got if I were investors in this webinar and I got $1 to invest, what should I look out for in terms of what does good look like to put my $1 down?
Yeah. That's a very good question, and it's not easy. I think that's where we have the board of directors, right, who would deliberate, like how much to invest or where to invest. To the question of what does good look like, I think the energy, because maybe again because I come from the education sector, so I think a bit of what Pei Hua had mentioned, and just to kind of extend from her views. So the bread and butter is your financial performance, and the energy which I have in mind is like you have a student, right, and the GPA. So if you have good financial performance, like you have a student with a high GPA, 4.0 and all that.
Oh, 4.0, that's perfect score. Probably a very high standard.
Or 3.5 and above, okay. And investors will take notice, right? Just like for us, we take notice of a student with high GPA. And when you look at sustainable activities, so once you have a high GPA, then you go beyond that, right? So that's the second layer, so as to speak. And companies that have ample resources, for example, I think the energy which I have is that they can do additional work or additional activities. In education, sometimes we call it CCA, right? They can take on volunteer work, be a leader, so on and so forth. Do good for society. And of course, just like a student would have to ask himself or herself, should I take on like 2 CCA or should I take on 3 CCA? Should I just focus on being, like what's my core, what's my niche and what's my core strength? So I think there's no like single answer for that. Different companies have different views, and I think that's where the board of directors will have to come together and what are the material ESG kind of issues or factors that they want to focus on. So if you have a Singtel, for example, compared to a CapitaLand, the ESG factors would be very different. They disclose that in the sustainability report, right? So they have a matrix, So what are the priority ESG issues that they want to focus on? What are the things which are maybe of medium priority, and what are maybe things which are of low priorities? And different companies also have different numbers of material ESG factors. So some of them have like 15 or 20, which means more CCA burden. You have like 20 ESG factors, all things equal again. That means you have to allocate your resources to all these drivers. Let's say you want
How do I compare, Prof? between company A and company B. There are different CCAs, there are different
Yes.
ESG factors, and both are telcos.
Yes.
Say Singtel and StarHub.
Yes.
Singtel and yeah.
Yeah.
So I know whether A or B is better than the other one, given the fact that the different ESG factors, even in the same industry, and we're
Yes.
still in a different industry. How do I harmonize once again what is good? What does good look like?
Yeah, I call this the kind of like the $1 million question, or even the $1 billion question,
Oh.
in the sense that if you know a financial statement is right now the evolution of financial reporting is a mature product basically. You know, the accountant know what to do because you have all these accounting standards which has evolved over, you know, let's say 100 years. You know, and of course you have new standards being you know, developed and so on and so forth. But essentially, the financial report
It's mature.
is mature. Yes, thanks.
$1 is
And
$1.
uh,
When you say $1, you know what $1 profit means.
there's issue of different measurement bases, right? So I'm talking about, let's say, you know, $1 of fair value versus $1 of historical cost. But let's yeah, but let's not go into that. But in general, if you look across, I mean, to your point of view, if you look across, let's say, company A and company B, the financial statement is mature in the sense that it's, if I may use the word standardized in the context of, let's say, they have four major financial statements, right? So they have the income statement, the balance sheet, the statement of changes in equity, the cash flow statement. So they are all required to produce these four major statements, and it's a common denominator, right? Dollar and cent. So
Yeah,
if
we all know what it means, yeah.
yes, yes. So you have company that show, let's say, reported earnings, right? EPS, you know, one company showing that, oh, I have you know, 20% EPS growth. Another company showing that 10% EPS growth. So again, all things equal, right? Investor would be, oh, I can make a decision. I would maybe prefer to invest in the company that's showing a 20% EPS growth, you know, rather than the 10% EPS growth. If, let's say, the valuation is all similar, you know, the P ratio are similar, and so on and so forth. So that help investor make decisions. And
But with non-financial statements, so
yes,
company A, we have happy employees. Company B, we have happier employees, which is more worth more money in terms
so
of valuation.
technically,
Happier means
happier
better.
employees is better. Study have shown that, but the difficulty is how do you measure the employees' happiness? So that's not easy. Some companies they use kind of like happiness survey and stuff like that, but there's shortcomings in happiness survey. So let's say, if, I mean, the classic example, right? So if a employee believe that their survey responses are not anonymous, then they would basically think everything is you know, everything is good even if they do
They'll
not.
rig the survey. Okay,
Yeah.
thanks for that, Prof. I
Yes.
think you laid the ground for a very good discussion. So let me come to Robson and then we pay. Well, let's follow Prof's discussion on happiness. So in the financial statements, you have your P&L, your balance sheet, your statement of changes, and your cash flow. So we know $1 is $1, given everything else is equal. But company A is happy employees. Company B is happier employees. So Robson, how do you measure happy or happier, and then you give a better valuation to these companies, and the better valuation one will attract more investments? But like Prof say, how do we measure the unmeasurable? What does
Well, I
good
think,
look like?
yeah, go on. Sorry.
Go
Sorry for
ahead,
the
Prof.
interruption. Well, I think first and foremost, happiness is relative. It
Yep.
depends on your peculiar circumstances. So the happiness of a retail investor, a mom and pop, investing with his or her CPF nest egg savings, it will be vastly different from an institutional investor, people who are more conscious of what's going to happen 20 years down the road when the ozone layer is depleted and your lives are at stake. Because at the end of the day, how do you converge mindsets? I mean, COVID was a stark reminder that above everything else, survivorship prevails. So everybody starts to behave more responsibly. You go out with masks, you take your vaccinations, wash your hands, maintain certain degree of cleanliness, and so on and so forth. I think that's one thing to consider. Coming back to your early question about the checklist that SGX requires listed companies to disclose, it runs the risk that people are just doing checklist ticking. And whether you have employees who attend classes or attend courses, Some fall asleep, some just go there for the sake of compliance and so on and so forth, but do they take it seriously?
Yeah.
So, and of course, it also boils down to the resources available to the company. So if you look at a catalyst company, an SME that is just listed,
No
vis-a-vis,
resources.
say, a GLC, a company that is like Singtel or you know, some as big as CapitaLand, they have vastly very different resources compared to an ABC company that's still struggling to make $1 million profit, and shareholders at the end of the day move very quickly if the counters don't perform. They demand dividends, and managements, if you look at most of their service contract, is benchmarked on profitability, returns, market cap, so on and so forth. So, you know, how do you harmonize, or how do you breach all these different mindsets to achieve a common outcome whereby we behave more responsibly? Because down the roads, whether ourselves or our next generation will die when Mother Earth dies, I think this is something that we have to keep in mind, and not just say it's nice to have. It's something that's going to happen in 300 years' time. You know, I'll be dead and gone by then. And so will be my next generation. So these are reality checks, I call it. But if there are guardrails, there are statutory legislative requirements, then you can foster a certain standard of compliance. But again, I'm not so sure for the smaller companies, because they say, look, we can barely afford the cost of listing or cost of maintaining a listing. What more to have all these things which you impose on us, which of course the bigger companies are comfortable because they have the resources, and they have a different objective because they want to project themselves. They have institutional investors, the funds, the insurance companies who expect that of them, vis-a-vis the mom and pop investors who invest in SME hoping to make a punt. They buy on hope, hold in greed, sell in fear. So, so there are a lot of differences. So I'm not sure how do we bridge the gap or harmonize it.
So today's word of the day is harmonization.
As an aspiration, it's an aspiration we must have, but how do we get there? I think it will take a while.
And one more question for you, Robson, then we go to Pei Hua. So Robson, you talk about training hours. So you have a company A who has a lot of resources, but the employees just attend for the sake of attending and clock up the training hours. But then you
Go
have
through
SME,
motion
or
as
go
what?
through the motion. So lots of training hours. But at the same time, you have SME, only one person attend the training and very few training hours. But that employee happens to be, his name is Mahatma Gandhi. He can change the world. But it's only one person attending 8 hours of training a month, compared to the big company has lots of hours. How do you rank the ESG quality?
You see, at the end of the day, it's not the training hours or how many employees attend, how many training sessions that would engender a positive outcome. Management has to take the lead. They have to drive home the importance of taking this very seriously. From some of my encounters with various listed companies, they seem to have a checkbox ticking mentality as well. So, you know, if the top management, you know, does not give emphasis or does not place importance on this, the middle management and the, you know, lower level employees would just say, well, we just have got to comply because that's expected of us by the market regulators. So, you know, and because this is something which I think the market, the stakeholders, the shareholders collectively must drive home the point that we are going to invest only if you comply in spirit and in the fullest sense of the word, and not just go through motion. So there's a lot of synchronization, but different companies have different financial positions and difficulties. So I think we need to take all this on board. But nevertheless, I think we should not stop to push for a better world because it is affecting us. As you can see, thunderstorms, floods, flash floods affecting all of us. I mean, as close as yesterday, even in Singapore, you would have read in the papers. So, but again, people will just take it, Singapore, it won't happen.
to us.
Yeah, we are safe from tsunamis and all that. And at the end of the day, who are we to tell them that they are wrong? Because they say, look, I have only 100,000 in my kitty and I hope to make another 20,000. And so don't tell me to put in counters, which may not make the same level of profit if I put my money with them. Because they are going to have this very long gestation period before I see some money, I see some profit. So who are we to tell them that they are wrong?
Okay, thanks for that, Robson. So we'll go to Pei Hua now to hear her views on what does good look like. But in the meantime, I'm going to pose a question to Prof. Prof, I'm going to ask you, is having a sustainability committee at the board level, is there any indication of good? Because SUSCOM is not mandatory yet. So you have RISCOM, AuditCom, NOMCOM, REMCOM,
Yes.
in terms of the comms at the board level.
Yes.
But if you have a SUSCOM or don't have a SUSCOM, does that mean anything? So let me let you think about that. Then I want to hear your views on that. And meanwhile, Robson, if you can think about greenwashing. So you brought up greenwashing. So I want to hear from your views and you can share with the audience. What's your view on greenwashing? Does it wash everything away in terms of all the good that's done? And, people are saying that they want to achieve net zero by 2030, 2050. But I think the talk is that a lot of companies will not meet their target because we're going to miss the 2.5 degrees in terms of the Paris Agreement. So is everybody greenwashing? Is it honorable? So let's come back to Pei Hua. So Pei Hua, what does good look like?
Right. After listening to Prof and Robson, a few points come to my mind. I think the first one is, I think all of us who attended finance investment course, we should remember about diversification in portfolio management. So I guess a good sustainable investment, we're not putting all the eggs in one basket. There's no harm to invest in, let's say, a high carbon emission company which still deliver good financial performance and it's a good investment. At the same time, I think it doesn't stop us from investing in, let's say, a rising clean energy companies. Yeah, so for instance, I think it can harmonize. It's not necessary that a green investment means low return. Let's say, but it's the timing. Timing of investing is important. So like right now, we have some clean energy big industry that is coming up. Let's say a hydrogen value chain. Yeah, we talk about in future, maybe there's carbon capture. So they are, but all this is a bit too early to invest now. But when after, I think all these new industries, they go through the similar industry life cycle as well. So introduction phase, we are still lowering profit. Obviously, it's not a good time for us to jump in. Try hoping that it can give you a multi-baggers, it can be a multi-baggers, give you a few 100% profit. So, I mean, to be a risk averse or in terms of weighing the risk of the investment, you probably have to wait and see they develop, starting to see profits. Maybe that's where you go into the growth phase. So this clean energy industry is green. You are growing your wealth or doing good as well, but invest at the right time. Yeah. So I think this comes to my mind.
So how do we know what's the right time for all these renewables?
Right. So you still go back to your financial. So you will see the
fundamentals.
reporting. Yes, the fundamental, you look at the financials, it show profits, right?
So don't
So
forget
if
the
it's still
fundamentals.
loss-making, you see, if it's still a loss-making a company, maybe we will wait. We may lose out the appreciation at the very beginning, but it's fine. But I mean, for us, the risk might be high. During this introduction phase, what if the company, the products was not well received, and it didn't even go to the growth phase. So the thing
fundamentals is still fundamental. Show me the money, and then after that, the renewables are the hope. So you buy fundamentals, hope that they will make another layer out of it and then make sure that they harmonize. And then that
Yeah, I was trying to say it can be harmonized.
So that's the word of the day, ladies and gentlemen, harmonization. And that's important because Prof. Kevin talked about S1, S2, ISSB, then you have the accounting standards, the non-accounting standards. If you do not harmonize, we have to stop counting already. We don't have to count the uncountable, and how do we add the things that we can count?
Yep.
Thank you for that, Pei Hua. So, while we go to Prof. Kevin, so Robson, get ready for your comments on greenwashing. Is it going to be a Adobe God for everybody? You know, we wash everything green and then nothing is left on earth. So, Kevin,
Yes.
does having a SASCOM indicate good in terms of the ESG strategy of the organization?
Yes. So before I answer this question, I just want to give my kind of like personal view on the question they asked before, I guess. And again, you know, for the participant, this is not financial advice. I'm not a financial advisor, so just a disclaimer. But I do like BYD. I'm personally invested in BYD. I feel that this is a good company. But
Build your
again,
dreams.
yes, yes, BYD. But again, I think if I look at my own investment track record, again, a bit of what Pei Hua mentioned, because my own investment portfolio is very diversified. So I'm just a very average investor. Yeah. But hopefully I have high hopes for BYD and hopefully they do not, they are able to deliver the goods. Yeah.
Build your dividends.
Yeah. Yeah. So back to the issue of sustainability community, right? So I think if all things equal again, because classical economics, right? If everything equals ceteris paribus, having a sustainability committee is good in the context of a bit of what I mentioned before, right? So if you think of sustainability initiative or sustainability reporting as something like additional like CCA, right? Additional curricular activities kind of thing. Even though of course now you have mandatory climate reporting. So the question again of cost benefit analysis, right? So what are the benefits of doing that? And what's the cost of doing that? So I think in a bit of like the good old days of HGM, right? Because sometimes you have this mom and pop shareholder will raise a question in the AGM, ask questioning about director fees, why is this director being paid so high or something like that, So when you look at the sustainability committee or how this is being formed, as what Mr. Loh mentioned, right? So you have the board of directors. So let's say you have 10 directors in this company, and then you have all the various committees, right? Let's say the nomination committee, remuneration committee. And then the question of whether you want to have a sustainability committee, right? So are you going to use the existing pool of directors, let's say the 10 guys? So in a way, you burden them with more work because now they have to attend, sustainability committee meetings and review and look at, additional issues. So from a company or from a shareholder perspective, right? So when you have a sustainability committee, if you just go by dollar and cents, then the underlying question from a shareholder, financial consideration is, are you going to pay the director more money? So in other words, right, let's say that this director is being paid $100,000 director fees annually. And then because of this additional responsibility, and then maybe there's a negotiation, then the director say, oh, you should pay me $120,000. So there's an additional $20,000 of expenses, which will again go to the P&L and reduce your reported earnings by $20,000 per director. And that means $20,000 is taken away, in a sense from the shareholders, and it go to the director bank account, right? And so that's one case. And the other case is, of course, the situation whereby a sustainability committee is being formed by the existing pool of directors, and they don't get additional director fees. So in other words, they get the same kind of director fees, and they have to work more hours. So ultimately, I think it depends. If you go from this angle of cost benefit, and cost meaning to say just financial costs, then it's a question of, or the issue of would there be additional expenses as a result of that So that's from the just from the director fees. But apart from that, of course, the sustainability committee members might during that deliberation, right, in the committee meetings, they might say, oh, we should do this, we should do that, we should have this initiative, we should hire, let's say, a chief sustainability officer and build a new office, get 10 more full-time staff and all that. So again, then of course, the cost will escalate. Yeah, in that context. Yeah.
Okay, thanks for that, Prof. Kevin. So maybe, Robson, you're a lawyer. Maybe before you talk about greenwashing, maybe I hear your views on SASCOMs. What's your view on SASCOMs?
Well, you see, the point is, it comes down to the cost of listing compliance. If you have a SASCOM, and most boards, they have 3 independent directors. They sit on the audit com, the RAM com, the nominating com, and then if there's a SASCOM requirement, they will just simply sit and form the com. So, but are they going to do very meaningful, substantive recommendations which the board would listen and implement, take due cognizance, or is just question of just go through motion? Which I understand many listed companies, even for the existing audit com, REM com, nominating com, it's a question of just going through the agenda and then no comments, okay, let's get on, and so on and so forth. So having an additional committee would not have meaningful impact if the board does not place importance on the outcome of what is expected of them as managers of their companies. So it all boils down to the attitude, the mindset of the C-suite team. So having another com, I'm doubtful it would have any positive, meaningful impact. That's my take. I've sat on listed companies, I've advised listed companies, and I sometimes gently chide or I'll draw the chairman aside and say that, you got to take this a bit more seriously, because at the end of the day, you have fiduciary duties, but most of them, they brush aside, say, well, let's get on, I don't have time for this. So it's, I think, but it's something that we can add on, but unless there is a total mindset change, and it's not going to improve things, at least not for some time.
And if I want to set up a SASCOM, Robson, what would be the one terms of reference that is really important to show that the SASCOM has skin in the game, that I'm serious?
Well, I think they have to understand that if their report is publicized in the annual report on how they had deliberated on the operations, the activities of the company, the group, and they stand by what they say, and at the same time also state categorically if management supports that, or the management is not supportive of it, then I think they will take their job more seriously, rather than it's all hidden in the company's secretary's records that the agenda has been passed, and they move on to the next committee. So if it's publicized and together with the sustainability report, then I think they know that there are many people looking at it, regulators, investors, the media. I think that they know that if the spotlight is on their forehead, perhaps that would make them take their job more seriously. Directors' fees, I'm doubtful, because at the end of the day, there's only so much that they can pay, particularly if it's a catalyst company. So I'm not sure if you increase their fees, that would have any impact, because they could then go to sleep without having to exert too much effort. He says, why bother? I mean, if management chairman tells me don't waste my time, don't waste his time, then I'll just quietly take more fees. But he says, no, no, no. Now, if the rules require you to publish this report and explain why this is not implemented, and next year there's going to be a follow-up, SIAS is going to ask not just the 3 questions, but more questions. Then they know that they are being scrutinized, that they have to be
Thanks for that,
prepared to
Robson.
be publicly accountable.
That's a very good point, Robson. Thank you for that. So we got about 15 minutes left. So let me quickly summarize what we have so far. And then Robson, you can come back to us on greenwashing, and Pei Hua also. What does bad looks like so that you stay away from sustainability investing or investing in a company that is seem to be doing sustainable things or green things? And then we asked Prof. Kevin also the same question. What does bad looks like? But so that's a summary so far. We need to look at harmonization. We need to look at fundamentals. We need to make sure that they all come together. And if you're going to set up a SASCOM, make sure that they're doing sustainable things, well, so to speak, that they're doing things which are of value to the organization and not just take more fees for the sake of taking more fees, so to speak. So maybe quickly to you, Robson, what does bad look like, especially greenwashing? Then we go to Pei Hua. So Robson, green.
Well, I think at the end of the day, greenwashing, in the simplest terms, is you simply just use a standard boilerplate, augment, change some of the language, compare what you said last year, and then publish it without any intention to realize what you are saying, and that therefore you are doing something and saying a completely different thing. It's just talk only, no action, NATO, no action, talk only. And that's when I advise companies on that, boards of directors, I say, look, you have a disclosure responsibility. There's a particular provision in the Securities and Futures Act and in the listing rules. If you publish something that you have no intention of doing, or in fact you're doing something that's completely different from what you are publishing, then you run a very serious risk. In a nutshell, that's greenwashing.
And so, Robson, if a company talks about net zero or net zero by certain year and all that, without any support in terms of the statement, would you think that that also constitutes greenwashing?
Well, I think if they publish a certain target or objective within a certain period of time, and I hope perhaps the regulators can come out and say, well, then you got to then outline how do you intend to achieve, what steps are you taking this year and the next financial year and so on and so forth until 2030, for example.
To show the roadmap.
To show that your roadmap is not just broad brush painting and then you kick the can down the road, because by 2030 you would have left the board. Someone else's problem.
60 under already.
Someone else's problem who sits on the committee and they say, oh, actually, we were not there when we made the statement, when the company made the statement. So I think there has to be a continuous follow-up or follow-through by the regulators and hopefully by the media, by SIAS, to say that, well, last year you said this, so this year, where are you in terms of achieving net zero? Where's your progress? You got to not just have beautifully crafted words, but what is your status of achieving? What difficulties or what things that you are doing to concretely fulfill, and what are the things that we can expect in the current financial year that you are doing in order to to meet this target. So every year you got to put the microscope on them.
Thanks for that, Robson. So let's go to Pei Hua. So Pei Hua, what does bad look like in terms of sustainability investing?
Yeah, I think before that, I also echo what Robson had mentioned. So we follow some of the companies, They do publish sustainability report, but pretty much is talk about historical what they have done. They're very mindful or to mention they may have a longer term target, but usually there's very little information as to how they going to implement it, which I think one of the reason is they are probably also concerned being held responsible. If they have give a very clear roadmap. What if they can't do it, and they probably will be marked as greenwashing as well. So I think something has to be done to encourage them to do more such disclosure. So beside greenwashing that we talk about, I think from the investment perspective, I will still talk about the numbers. I think financial-wise, companies' profitability, especially for clean energy, which is still at the early stages of development, they tend to be pretty over-reliant on the subsidies or government support. So in the event of any reversal of those policy, this may result in plunge in their profit or even push them into losses. I think the other pretty common, I would say, investment disaster is probably it's not just in this so-called clean energy sector, or it would be like excessive expansion during the industry growth phase. Company tend to over leverage, and when the industry suddenly turns too much competition, they ran into cash flow problem. I think we have, I mean, if I could quote an example, we have seen, let's say renewable, if you could recall 4-5 years back, it was a darling. Many people rushing to invest in renewable. And I think we started to see some cracks, companies making provision, impairment because the tariff was too low, interest rate was too high. They have resulted in all the asset impairment, which caused the stock to actually correct quite a bit in August last year, if I recall. Yeah.
So fundamentals. Don't lose the numbers.
Numbers don't lie.
Thanks for that, Pei Hua. So, Prof, we got about 10 minutes left to this webinar. It's been an exciting discussion so far. We talk about harmonization, talk about fundamentals, we talk about sustainability committee, and all these points to whether there's good or bad in terms of sustainable investment or ESG investment or green investment. There's a comment from the floor that talks that there's a difference between ESG and sustainability. Definitely there's a difference, but that's for another day. We'll come back to that. But Prof. Kevin, 10 minutes left. What does bad looks like? And then we'll go to Robson. What's your summary? What's your takeaway for the audience? And then from Pei Hua, what's your takeaway for the audience? So, Prof. Kevin, what's your takeaway in terms of what is good, what is bad?
Oh, sure. Yeah, and I think I saw. I mean, before I come to that, I have seen the comment from the participant on the ESG and sustainability. So so that was a very good comment that was being brought up, and basically for ESG, right? I mean, environmental social governance. So basically, this is like framework, to assess, let's say a company. So you're going beyond just financial performance. You're looking into social performance. You're looking at environmental performance in that context. Sustainability, in a way, the definition that is very popular from the UN, United Nations. I think some, or if not everybody, or most of you have heard of that definition. Sustainability is defined as meeting the needs of the present without compromising the ability of future generation to meet their own needs. Yeah, so that was his first comment. Second comment on that, which is the notion of happiness in employees, right? How do you measure that? So that I think go back to the issue of the SGX core metrics. So one of the SGX core metrics is number of let's say training hours, right? And if you look at, for example, say it's like that notion of an input-output approach. So basically, if you have, for example, so I think the question or the comment actually was employees or happiness in employees measured by indirect or proxy indicator, and then employee satisfaction index by a third party. So the framework, or what is easier to measure, is actually the inputs. So for example, say if a company spend $100,000, let's say, into employee wellness, right? So that's easy to measure and easy to quantify. Well, company did allocate $100,000 into various, let's say, wellness activities, things like that. I think in some big tech companies, they have they have everything, right? They have pantries, very generous, like they, basically, I think some of the big tech company have like massages even or something like that, Basically, you can stay in the company 24 hours and not leave the premises, you'll be well fed, well taken care of, and so on and so forth. So in that context, if you want to measure, let's say, are my employees happy or well trained, the notion that if you use just the inputs, right, it's easy to measure, but ultimately, if you spend, let's say, $100,000 on an employee and he's not happy, because happiness is subjective, right? Vary from people to people. I mean, if I receive $100,000, I'm happy. Mr. Low, I think if you receive $100,000, that's not enough, right? Or something like that. Again, just yeah.
So in conclusion, Prof,
yes.
how do you know whether a company is sustainable or not? Is it having more training hours, having more pantries, more freebies, work from home, come to work in Bermudas? Is that sustainability? Would I invest in a company like that?
If I look at the SGX core metrics, right, then so SGX basically come up with a list of like the various E, S, and G metrics. So for the E, is like you have your scope 1, scope 2, scope 3, carbon emissions. So how much how much carbon emission basically the company is producing through its whole entire value chain of activities. And for S, the S is, I think, the hardest to quantify and measure. And in that context, I think SGX, many of the measures basically using an input approach. So if you spend more money on training, on wellness, on happiness, on your employees, yeah. So most of the metrics are inputs measures. Even if you use an output measure, let's say, or you try to quantify, for example, let's say through a survey, whether by a third party or by in-house survey, again, you run into some of the shortcomings of survey method. The survey participant might not tell the truth. They might be afraid that their responses are not anonymous, for example. They might, so and so forth. So it's not easy, in other words, to quantify social performance. Governance at this point in time, some well-known governance metrics like let's say gender diversity, number of independent directors. So these are the so-called very traditional governance measures. But again, if you have gender diversity on board of directors, so what is the optimal number? Is it 50-50? That part is not clear.
So still a lot of subjectivity in terms of measuring what is good, what is bad with respect to sustainability investing or green investing or ESG investing.
Yes, I would say so. I mean, my personal opinion, like if you look at E, for example, in some sense, the holy grail, right, is to have carbon neutral, right, net zero. So in that context, if you have less carbon emissions and everything else equal, that's like that's like a good thing. So less carbon, less CO2 emission is a good thing, right? And if a company is able to go all the way to such that it's carbon neutral or net zero, then they are not sending out more CO2 emission into the environment. But on S and on G, I think that's what you mentioned. Where is the so-called the optimal point? If you bring in, for example, say if your entire board of directors are all basically male dominated, right, and you bring in one female into the board of directors, of course, I think most people will agree that you have increased gender diversity. But then after the first female director, the second one, the third one, the fourth one, that part is not is not so clear. The incremental effect would not be so clear, I think.
Okay, thanks for that, Prof. So let's go to Robson, and then to take us home will be Pei Hua. Robson, give us your wise words as to how do we look at what's good, what's bad, and then what will be your key takeaways?
Well, I think bad is if the company's management and board of directors defraud, cheat, do things that are completely different from what they say, to induce shareholders to continue to invest in them, to raise the stock price so that they get higher share of profitability benchmark against quantifiable metrics like share price, market cap, and so on and so forth. So that is also something that greenwashing would come under. In other words, you are doing something that's completely from what you are telling the public. And I think one important point to bear in mind, whether is it a good investment or bad investment, it goes to your investment horizon and appetite, because renewable energy needs a lot of capital. The gestation period to profitability takes a long time. Companies could be bleeding profusely before you see before they even break even. But then investors, do you have the appetite? Do you have the wherewithal to see this through? I think most people, particularly retail investors, may not. Even institutional investors and funds, they have their ROE and ROI. They can't be investing in something that's loss-making for 7 to 10 years. And that is reality check, because whether is it turbine, whether is it any form of renewable energy, hydrogen or nuclear energy, so on and so forth.
So fundamentals are still the day, order the
It's
day.
fundamentals. It's not just quantitative, it's qualitative as well. So I think this is something that it's very hard to make a empirical statement and say that this is the standard, this is the gold standard. Good and bad, it all depends. So investors, at the end of the day, you have to decide for yourself. What do you expect from your investments? What do you hope to see? Are you there to make a better world for tomorrow? Or you are just simply trying to augment your nest egg? Which is not wrong, as I've said. It's not for us to tell them whether they are right or wrong. There are realities that we need to take on board. There are aspirations that we need to fulfill, because at the end of the day, we all don't want to be dinosaurs. The world ends and everybody dies. So, but then again, people say, look, you are scaremongering, it's not going to happen in our lifetime. 100 years later, 200 years later, we'll be all dead and gone anyway.
So why bother?
So why bother? So, well, but again, we have to, have certain standards, because whilst we are still alive, it may happen in our lifetime. Who says that it's going to happen in 100 years' time? It may happen 5 years from today, right? So let us not let down our guard. Our government is doing the right thing. The global community is increasing, beginning awareness that if we don't do something right now, we relax, we go back to our comfort zones, then everybody may just end tomorrow.
Thank you for that, Robson. And now over to you.
I will have a very quick one.
Okay.
I definitely echo Robson. Be investors or companies, I think we probably should adopt a more balanced approach in sustainable investing. I think the good, it's obvious that it should be a company with very sensible strategy, responsible and committed management, overlaying fundamental with the ESG. I think the bad, like what Robson had mentioned, I think corporate governance historically, the breaches are the worst, especially involving frauds or scams and potentially leading to a complete loss of investments.
Okay.
Short and sweet one.
Thank you for that. And it's 8:32 right now, so we're just 2 minutes over the time limit. So just quick summary: harmonization, fundamentals, fundamentals and fundamentals. And we hope that we don't become dinosaurs tomorrow. So with that, so thank you, Prof. Kevin, for your presentation and for your comments. Robson, for your deep insights. And Pei Hua, the first time that you're joining us in the SIAS event. Thank you very much for your participation. And
Thank you for
to
having
the
me.
audience, thank you very much for joining us this evening as part of the SIAS Corporate Governance Week. And now, thank you very much. Have a good evening.